So the stock market has officially entered bear market territory. Some of our favourite stocks are now down 20, 30 and some even down 40%, and it's looking quite likely that there's going to be a little bit more downside to come. But as investors like Shelby Davis once said, you make most of your money in a bear market, you just don't realise it at the time. And it's certainly true, because investing into the stock market whilst it's falling down in value could just be the best opportunity of the next decade in order to maximise your investment returns. So how on earth do we do it? Well, don't get me wrong, stock picking is certainly far from easy, but it's certainly not impossible. And you don't necessarily have to be a fortune teller or even indeed an investment analyst at Goldman Sachs in order to make some good investments in the coming months. Because in actual fact, thankfully for us, we have all of the data available to us to look at companies from the past who have survived previous market crashes and then gone on to prosper. And the reason why I like to look at some of the historical data is because whilst history doesn't always repeat itself, it certainly is a good indicator of what's to come. And if you don't have the instant gratification gene that Charlie Munger says, then now should be a good opportunity for you. You should be in quite a good place to benefit in time. And when I talk about instant gratification, I'm talking about the expectation of buying a stock today and then receiving or expecting to receive wild rates of return within a 12-month period. Because truth be told, any stock investment which you've made, in my opinion anyway, should at least be a 3 to 5 year play at the bare minimum. Because as history tells us, the longer that you can stay invested into the stock market, historically speaking, statistically speaking, you should certainly go on to benefit more. And as such, the investment that we're going to be talking about today has been a 2.5 decade play, which has gone on to provide investors a rate of return of 121,733%, and is now one of the biggest companies on the planet today. And that stock is a company called Amazon. Now, the reason why I'm talking about Amazon today is because during the dot-com bubble, when the bubble eventually burst and stock prices came crashing through the floor, Amazon's stock price actually dropped 95%. It went from $113 per share down to just $6 per share. But it's the criteria behind investing into a stock like Amazon back in the early 2000s that I want to talk about today, because it's this very criteria that allowed investors to still have confidence in Amazon as a company, and therefore they were able to go on to achieve a huge return on investment over the course of the long term. It'll almost be a step-by-step checklist for you to simply tick off as you go on to do some more research on the stocks that you're looking to invest in. Because if all of the criteria that I'm about to share with you guys is ticked off, then when this stock market crash eventually finishes and things take a turn for the better, then you could very much be sat on a gold mine. And who better to explain how Amazon not only just survived the dot-com bubble crash, but also went on to thrive thereafter than the man himself, Jeff Bezos.
That whole period is very interesting because the stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way.
Now let's dissect what Jeff Bezos had to say, with the first thing being around that the stock is not the same as the company. Now what he means here is that the price of the stock, the valuation of the company, shouldn't be a distraction away from the underlying fundamentals of the business. Because as of right now, Amazon stock is actually trading down about 40% from all-time highs. And as I said, when the dot-com bubble burst, the stock was trading down 95%. But whilst the market value of the business obviously changed, the underlying fundamentals didn't. So in actual fact, if anything, you're just being presented with an opportunity to buy into Amazon stock whilst it's trading at a slightly lower price to earnings ratio. And we all like to see more bang for our buck, and it's no different when investing into stocks. And whilst we're on the topic of the underlying fundamentals of a business, that leads me on to point number 2, which is around analysing internal business metrics. Now interestingly, Bezos focused on the number of customers rather than that of total revenue. The reason being, as Bezos highlighted in this 1999 interview, he very much wanted to focus on the customer experience and providing great customer service.
It doesn't matter to me whether we're a pure internet play. What matters to me is do we provide the best customer service. Internet, schminternet.
And the reason why he emphasized the point around the customer being so important is that if you have a business that provides a great customer service, those customers will keep coming back. And as a result, Amazon has become the online version of a convenience store. It's quick, it's good value, and it's convenient. And as a result, customers come first and revenue comes second. And whilst we're in an environment right now when inflation is running hot at about 8.6%, it's expected that consumer spending will certainly start to slow down, which is why I could certainly argue that investing into stocks which have a strong customer base, which certainly results in revenue stability, could certainly be a strong play during these difficult times ahead. And funnily enough, all of this theory not just translates into Amazon's performance today, but it also translates into their performance 20 years ago. In their 2001 annual report, right in the middle of the dot-com crash, Amazon recorded a 13% growth in sales from the prior year, achieving a revenue of $3.12 billion, along with increasing their customer base during that period by 25% to 25 million customers. Now, when we translate that into most recent figures in this current bear market, Amazon is still seeing revenue growth during Q1 of 7% year over year to $116 billion from the roughly 2.7 billion people that visit Amazon.com on a monthly basis. That means on average, every customer that goes on to visit Amazon is likely to spend $14.32 per month. And with that revenue figure still growing exponentially year in, year out, with revenue being up 102% just in the past 4 years alone, it certainly speaks volumes about the underlying fundamentals of the business not changing, regardless of what the stock price is doing. So with a strong customer base instantly providing financial stability for the company, it very much means that Amazon aren't vulnerable to the volatility within capital markets. Which leads me on quite nicely to point number 3, which is to focus on companies that are financially healthy, just like Amazon was back in the early 2000s. Here's a clip of Jeff Bezos to explain.
We didn't need to go back to the capital markets. We didn't need more money. The only reason, a financial bust like the internet bubble bursting is, makes it really hard to raise money. But, we already had the money we needed. So we just needed to continue to progress.
Now, many of the companies that went bankrupt during the dot-com bubble were companies that didn't have a strong customer base and they didn't have the cash available in order to continue financing business operations. And due to this, there was an exodus of bankruptcies amongst lots of tech companies at the time. But Amazon was a company that held up strong, to the point where they actually called out during their annual earnings report at the time the absolute importance of having a strong cash position. It says, why focus on cash flows? The answer being because a share of a stock is a share of a company's future cash flow. And as a result, cash flow more than any other single variable seemed to do the best job of explaining a company's stock price over the long term. And as a result, as you'd probably expect at the time, Amazon was sat on cash of $540 million, which in percentage terms was about 17% of the company's total revenue. Now fast forward just over 2 decades, in today's terms, Amazon actually have $66.3 billion in total cash, which actually makes up 14% of the company's total revenue today. So in percentage terms, believe it or not, Amazon were actually relatively better off with their cash to revenue position back in the early 2000s than they are today as a massively established business. Regardless, with that level of cash back then, along with the level of cash which they have now, it certainly gives them the security to push through the bad times in order to benefit from the good, which I'd say is an extremely important point, especially in today's environment. With interest rates on the rise, debt is becoming more and more expensive. However, companies that have plenty of cash available can either use it to service some of that rising debt, or instead use that cash to reinvest back into their business in order for it to be able to scale and grow. Which leads me on to point number 4, which is profit isn't everything. Now you might be thinking, hold on to your horses, what do you mean by profit isn't everything? Surely profit is the most important thing when you're investing into a company, because fundamentally businesses need to turn a profit in order to stay alive. And of course that's certainly true, but if you're looking at discovering the next Amazon of the future, then it's highly likely that those kinds of businesses will very much be in an aggressive growth phase of their business cycle, and therefore the only thing that they really focus on is reinvesting back into the business, and therefore it's highly likely that they won't actually be turning a profit, because back in the early 2000s Amazon was in the exact same position, with it actually being one of the biggest critics of Amazon investors, because the stock was making loss after loss after loss.
Amazon was, people always accused us of selling dollar bills for 90 cents and said, look, anybody can do that and grow revenues. That's not what we were doing. We always had positive gross margins. It's a fixed cost business. And so what I could see is that from the internal metrics is that at a certain volume level, that we would cover our fixed costs and the company would be profitable.
But as Bezos rightly said, he knew that the business could turn a profit if he could go on to scale it further. And as he scaled the business, he was able to marginally reduce his costs over time, and therefore eventually go on to turn a profit. Even now, you could certainly argue that Amazon are running at razor-thin profit margins, only making 7 cents in net profit for every dollar made. But I think the important point to make here is, especially in a business's early days of growth, it's more important to look beyond their profit figures. Instead, the more important metrics to look at, in my opinion anyway, is whether the business can continue to scale, continue to grow their profit, marginally reduce their costs over time, as well as have a strong cash position too. But there is one final thing that I would add to this checklist, and that's point number 5, which is to look at a business that is building something for the future. The world is moving so fast these days that if you're not looking at least 5, 10 plus years ahead, then you're probably being too short-sighted. Any company that I'm looking to invest into, I personally need to have the utmost confidence that they're going to continue to innovate and develop and build and grow over the course of the next 5, 10, perhaps even 20 years. And that certainly becomes a huge challenge because I'm not exactly a fortune teller. But the reason why it's so important is because as technology continues to develop and evolve and change so quickly, as we saw in the past, many companies that failed to adopt this new technology were the ones that ended up going bankrupt. And in actual fact, by 2027, the average tenure and life expectancy of a company held within the S&P 500 index is expected to drop to just 12 years. Now, for context, the average lifespan was about 33 years back in 1964, which highlights more now than any other point in time in history that no company is too big to fail. So on that note, it's probably worthwhile looking at some of the mega trends that we have upon us. Things like electric vehicles, renewable energy, blockchain technology, artificial intelligence, big data, and the list goes on. I think if you're going down the route of investing into individual stocks, positioning yourself well for the future will be absolutely imperative for long-term success. So they certainly are my 5 fundamentals to stop picking success in a bear market, but be sure to let me know what yours are down in the comment section below. But before you go, if you want to understand a little bit more about why this current stock market mayhem that we're seeing could just be an opportunity of a lifetime, then be sure to click on this video here. And with that being said, I'll see you over in the next one.